Good morning, good afternoon, and hello. I'd like to welcome everybody to today's webinar, the 2019 Mid-Year Nonprofit Accounting Update. As most of you know, my name is Max Smith. I'm with 501c Services. Just briefly about us, we're a 100% employee-owned company, and we provide alternatives to state-run unemployment insurance programs. We provide services to more than 1,500 nonprofits nationally, partially through our administration of the 501c Agencies Trust. We also administer the Boy Scouts Unemployment Plan, and as well U-Insure, which is a stand-alone product, first dollar product for nonprofits, government entities, and tribally owned businesses. Lots of folks on the webinar today already work with us. We appreciate you doing so. If you're not working with us, you should look us up, let us run some numbers for you, and we might be able to save you all some money. Go over a little bit of housekeeping before I turn over the program this morning to Matt. Matt is going to periodically stop for questions throughout, and then we will cover as many questions as possible at the end. So if you have a question, if he's talking about puppies and you have a puppy question, please go ahead and shoot that into the questions queue of your GoToWebinar browser, and we will curate those on our end and try to get everybody's questions answered. The materials are already in the browser under handouts, so you can download those now and follow along. I'll also distribute those via email later today, so if you don't download them now, you'll get a copy later today. As many of you are here for CPE. Matt's firm, Marks Paneth, is going to provide that CPE, so you know the drill. There'll be a couple of polls throughout. You're going to have to answer the polls. You're going to have to make sure your browser window is open so that the monitoring software says that you're paying attention. And then there's a post-event survey that you need to complete to prove that you were there at the end. Matt's team will process the CPE as quickly as possible, but honestly, you should give them a couple of weeks to do so. But if you feel like it's been too long, you haven't heard anything, please feel free to email me and I will check on it for you. Like I said, please give them plenty of time to get everybody processed. We have over 200 people on the webinar today. We don't have a webinar in September, but we do have one in October. It's on nonprofit recruiting strategies. Everybody will get an email about that. Share it with your team. Please attend. Now, while I hand off everything to our speaker today, Matt, I'll go ahead and introduce him. I don't know if I can, Matt, if I could talk and do it at the same time. I might have to pause here. But Matt is a senior manager with our friends at Marks Paneth. He has more than 10 years of experience in a nonprofit practice group, and he can sometimes be found conducting audits for those organizations that receive federal funding. So Matt, I hope you're ready because it's all you.
Thanks, Mac. Good afternoon, everyone. Thank you for joining us today, and thank you to Mac and 501c Services for hosting us again, as Mac said. So in my day job, I'm an auditor with Marks Paneth LLP, based out of New York City. We're a larger firm, but I work only with nonprofits, primarily large and mid-sized social service agencies, schools, foundations, advocacy organizations. I really love doing these updates because it gives us a chance to step out of the auditor role and be a little more proactive in helping you plan and think strategically about how you present financial information and the face on it that you put to the world. One other exciting part of this, maybe it's only exciting for me, but over the last few years, FASB has made our lives much easier in preparing these updates. The pace and the significance of the standard changes that are hitting nonprofits is tremendous. FASB's own roadshow is marketing this as the biggest set of changes since the 90s. So since we only have an hour today, we'll briefly cover some of the major changes. The agenda is here. We're going to spend some time first going over the presentation changes to the financial statements in ASU 2016-14. This is effective now. It should hopefully not be brand new to anyone. December year-end organizations have already implemented it in GAAP basis financials, but given that we're approaching audit season for fiscal year-end organizations, we're hearing from a lot of CFOs and controllers. Maybe they've been in trainings in the past, but it's different when it comes time to actually get down to drafting this, and it deserves a second look. I also want to go over some of the lessons that we've learned from organizations who have already implemented it, so hopefully be helpful to fiscal year organizations and anybody doing it going forward. Even if you've already issued financial statements under the new standards, I think it's helpful just to refresh and make sure you've covered everything. We'll then spend some time on standards for conditional contributions, ASU 2018-08. Then leases, I only have a few slides on. You could take a deep dive and do a half-day CPE on leases. And if you have a lot of leases, that might end up being the best thing to do. But the overarching concept isn't so tough to explain fairly quickly. And what's brand new in the last couple of weeks is FASB has also proposed extending the due date to the standard by another year. That's not final yet, but they've already voted on it. So unless you have public debt or a conduit debt obliger, this is now getting moved. The lease standards are getting moved to calendar year 2021 and fiscal year 2022. In some form, that standard's been around for a long time. So before we get too far into this, I want to do our first polling question to check how comfortable you are with the new financial presentation standards. Get a sense of who on the phone has already implemented them, and I know this has been around for a little while, so it's something that you may have, that I think most have seen in some form.
Right, we got about 70% of the people voting. Currently, we're looking at about 55% say they're somewhat comfortable. 18% are very comfortable that they've already implemented them. 18% have implemented a little bit, and about 11% are not sure.
Great. That's what we're seeing essentially across the board, so I think makes a lot of sense. And I know if you're part of those 18% where you have issued financial statements, this is going to be a refresher, but you might still pick something up for future years, and it's a good opportunity for people who have general knowledge about it, see what's going on. So let's dive into this. And just as a quick refresher, the objectives of this whole thing were, first of all, to update the current model. Particularly the net asset classification terms were confusing to lay readers of financial statements. What we used to call, under the old model, unrestricted net assets, were not really necessarily available for your organizations to use. You have board designations, legal requirements, any other number of conditions around use. So there's a feeling that unrestricted was too soft a term. For example, when you have bond escrows that are on the balance sheet as restricted cash, but then show up in the net assets section of the balance sheet as unrestricted, it causes a lot of confusion to anybody who's not really a professional looking at these. So that term unrestricted was too soft. And then on the other side, after states adopted MIFA in the wake of the financial crisis, in New York, we were one of the last states to do it in 2010, but permanently restricted is also not really a great name. Since under law, you're allowed to spend endowment earnings and go below the historical gift value of the donor's gifts. So that was also confusing to financial statement readers, and we'll see how FASB addressed that. The second major change is to improve information about financial performance and liquidity. And again, if you're near the New York area, we had a major social service provider in New York called FEGS that went bankrupt. Some of the warning signs were there on the balance sheet, but were not really managed or interpreted correctly. So from an analysis standpoint, let's say you're a foundation gauging financial health or sustainability of a potential somebody you want to give a grant to, I think the liquidity disclosures will be incredibly useful. And we're seeing a lot of discussion on that. So that'll be important for nonprofits to pay attention to. And the final bubble here is to better enable organizations to tell your financial story. And it's really key. You'll see in a lot of these changes, there's flexibility that is built into the standards. I think particularly with the liquidity note and the functional expenses that we'll speak about later, there's really an opportunity to communicate your story to the reader. So it deserves some attention, not just from the accountants and your auditors, but also some thought as to who's actually using these documents, what sort of message do you want to convey. I think that's the best way to think about these. The effective date, as I said, it's effective now, December 31st, 2018 financial statements are under these standards. Any fiscal year 19 statements will also be under the standards. So what are the key changes? We'll go over each of these, but some of them will be very fast since they're pretty straightforward. A change in net asset classification to two classes of net assets. along with some associated changes to accounting for underwater endowments. Next, as I said, new qualitative and quantitative disclosures on liquidity and availability of resources. A requirement to present expenses both by function and by nature, and also to disclose how you're allocating expenses. And the bottom ones I think are easiest. Investment expenses now are required to be presented net of the return, and statement of cash flows, the reconciliation to the indirect method is no longer required. That's definitely the most minor. The majority of organizations that we see use the indirect method already. So one reason I include this is that in the exposure draft, if you've been following this closely when it first came out, FASB had suggested all these changes to the statement of cash flows to try and force net cash to or from operations to reconcile to an operating measure on the statement of activities. They got tremendous pushback on that, and it ran into a lot of problems actually thinking it through for the final standards. So that's been left out, and this cash flows has remained essentially unchanged. And as Max said, if I go over any of this too quickly, I'll try to leave some time for questions, but the slides will be emailed out so everybody gets this. Okay, so first, net asset classifications. This was really the headline change of the standard, and at the end of the day, I don't think it's that big a deal. It's mostly cosmetic when you look at some of the new financial statements compared to the old. I already spoke a little bit about the problems with the terms unrestricted and permanently restricted. The new terms, they don't exactly flow off the tongue, but unrestricted becomes net assets without donor restrictions. Temporarily restricted and permanently restricted are getting combined into one line item called net assets with donor restrictions. The old disclosure requirements still remain, so you do have to disclose the nature and amount of different donor restrictions. You're all also now specifically required to disclose any board-designated net assets, which are included in the without donor restricted line item. One thing I'll say is that the associated law behind how you use gifts from donors has not changed. So we're recommending, even though these changes are on the face of the financial statements internally in your accounting or your GL or how you report, I don't think in most cases you don't need changes to those systems because you can very easily translate that into a financial statement presentation change. You're also allowed to disaggregate these line items further on the financial statements, and in the practical implementation of all of this, we've seen exactly that. Organizations still want to disclose what's endowment corpus on the face of the balance sheet, and that's perfectly allowable. I happen to prefer that presentation, and we have an example in a few slides, but it's also not required, so if you want to keep that disaggregation information entirely in the notes, that's also acceptable. The real change in accounting is for underwater endowments. It goes beyond just presentation. And it hasn't been as much of an issue in the last few years, but for anybody who had endowments in 2009, 2008, remembers that when funds go underwater, which is that the market value of your endowment is below the historical gift value of the gift that you got from a donor, you used to show that deficit in unrestricted net assets. That's now changed under these new standards, so the total endowment value is now included, just as the market value, in net assets with donor restrictions. And the logic here is that, as I said, UPMIFA, the Uniform Prudent Management of Institutional Funds Act, essentially allows you to continue spending on an endowment even if you go below the historical gift value. So if your spending policy says that you're taking 5% of the average market value of the fund over 5 years, and that's what you are pulling into your operations and budget each year, you can continue to do that even if the market tanks and the fund goes underwater for a little bit, which makes sense because that shouldn't hurt your operating flexibility. Although you have the option to change the spending, the law does allow it. So it really doesn't make sense from an accounting perspective to show the corpus value as restricted and then a deficit that is not, which was the old methodology. You do need to disclose any underwater endowments, but as I said, if it comes, especially with the market volatility recently, we're seeing some more of this. So really, the market value of the endowment will stay in the restricted column of the statement of activities. This is an example of how the net asset section of the balance sheet will look. The absolute minimum that you can choose to present is here on the top left. So you see just 2 line items with and without donor restrictions. But what we're seeing really in practice is something that's closer to the bottom right, which shows the components of net assets and lets the reader kind of see what makes that up right on the face of the balance sheet without digging into the notes and trying to do some kind of back of the envelope math. And one reason for this, as we've been implementing, is really from thinking about this from the donor's perspective. One item, it's not on this particular example, but we often see broken out, is net investment in property and equipment. So particularly if you have a capital-intensive organization, net assets without donor restrictions number can be high. That doesn't necessarily mean that you have a ton of money. So by disaggregating, keeping a line item for capital items and any board-designated funds, you can show kind of the true smaller number that's available really for you to use as operations, and often we see that that's more compelling to a donor. So that's what we talk about by using the statements to tell your financial story. There's opportunities there to shape your message as is kind of most effective for your organization. Hopefully my last word on net asset restrictions, the standard includes some clarifying language on gifts that are restricted for property, plant, and equipment. So when you think of a capital campaign for a school or a museum raising money for specifically for a new building, the standard requires nonprofits to use the placed in service approach, which means what that means is that when the asset is placed in service, you get your certificate of occupancy, the building's open, you release all of the restrictions that are associated with that. So why is that important? If you think about the statement of activities and the without donor restrictions column and the with donor restrictions column, that release into revenue of without donor restrictions occurs in year 1 of the asset, while the associated depreciation expense will occur over the useful life. You used to previously have the option to time the releases to match the expense, but FASB's determination here was that the restriction of the gift was really to build or acquire the asset. Once that's done, you've fulfilled your obligations to the donor and the gift is released. There's an exception if the donor explicitly states that, for example, you need to hold the building for 20 years, 30 years, something like that. You could see a situation where it would be both time restricted and purpose restricted. So you could, in that narrow case, time the releases throughout the life of the gift. Also, in practice, a lot of times you'll build the asset before all the money is collected from the donor. So there can be other associated time restrictions that stay within the with donor restrictions column. But for anything that you've received and is otherwise clear to use against the building, once that building is placed in service, it needs to be released immediately. Okay, the next part of the standard, and I've seen this as kind of the most important and really the one that requires the most level of thought. So I said a new note disclosure about liquidity and availability of resources. What's actually required? Well, there's 2 things. First is qualitative information about how you actually manage your cash flow and operations. And second, quantitative information about the financial assets that are on your balance sheet that are both, first of all, liquid, and second of all, available to use for general expenditures. So there's 2 parts of that. Liquid is easy enough. It's anything that you can convert to cash within 1 year from the balance sheet date. What's available is more difficult. And it's easy to think about things that you can exclude actually from available. So funding reserves, like I mentioned, a bond escrow fund, or a board-designated fund that management can't use for operations but it's controlled by the board. Any donor-restricted net assets, those are all things that you cannot really use, or you being management, but management cannot use for day-to-day operations and meeting general expenditures of the organization. Some other things to mention here that we've seen from adoption of this is that your qualitative disclosure should include other sources of liquidity. So for example, if you have a line of credit, that should be included. If you do have an endowment with a spending policy and you know what the amount that you take into your budget each year, that should be incorporated into the analysis. As I said, I see this as being the single most important change of the standard, even though at the beginning it got comparatively less press. Because these are the only real requirements, there is a real flexibility and an opportunity to speak to the reader about how you manage your operations. If your balance sheet is relatively weak, this is where you kind of can explain away any questions about how you actually manage day to day. And on the other side, if your balance sheet is strong, but if it looks strong at a top level perspective, but you want to raise funds, you can really use this to show a reader why you might be deserving. And another surprising area about this disclosure, I was speaking about this today to somebody outside the firm, but it was an audit partner who does not do a lot of not-for-profits, and they didn't understand why there was no mention of expenses in this footnote or debt. And it's true, there's no requirement to show any outstanding liabilities or expenses. Anything that would be associated with the use of cash is not here. An informed reader could really pick up all of that from the rest of the disclosures in the financial statements, but the note doesn't require you to lay it out there in one specific place. So I have an example here, and I think this is from the ICPA. I don't want to take the time to read through this in detail, but I wanted you to at least have something in the slides so you could see what this thing actually looks like. And there's now publicly available examples as places have adopted, and in some cases early adopted, of real notes out there also to look at. But you'll see that this shows the quantitative table of assets that are both liquid and available. That's the top part of this, and then has a few paragraphs of a qualitative discussion on how cash flow is managed. One alternate presentation that I'd suggest to this that I particularly like is to show the table with a subtotal, where the first item you come to is just financial assets that are on the balance sheet come to a subtotal that can tie directly to the face of the financial statements. And then you can add items and reconcile based on what is not liquid and available. So that might say, here you have cash and cash equivalents, accounts receivable, investments, pledges. All those numbers can be from the financials, come to a subtotal, and then say, well, you also have money that's being spun off of the endowment that gets added back. Reduce any donor restricted or board designated funds that are not available for use. Any pledges that are not liquid, due in more than 1 year. And I think it gives some more information for somebody who might flip back and forth between this note and the balance sheet. So I think that's a cleaner presentation, but given the flexibility I spoke about, that's entirely up to you and what you think is kind of best and most useful to communicate. Okay, the last major piece of this standard is to require expense reporting by both functional and natural categories. Reporting by function, which is really program, administration, and fundraising, is already required. Natural classification was not previously required for everyone. Voluntary health and welfare organizations needed to show it. In some industries, it was standard. Some it was relatively uncommon. Schools, for example, had their own classifications that were set by NACUBO, and other industries have followed kind of different guidance, but now you have to show both. It can either be as a separate statement or in a footnote. It can't be as part of a supplemental schedule to the financial statements, which had been common practice for some, but now that needs to move as part of the basic financial statements. And really, in practice, we're seeing everybody put this in a separate statement of functional expenses. I haven't seen an example of a footnote yet, but there is the option within the accounting literature. And even if you haven't done this in your financial statements before, people are generally familiar with the table from the 990s, so the preparation doesn't seem to have been that big of a burden for most of our clients. The standard does go a little bit further than just requiring a statement. You now also have to disclose the methodology by which you allocate costs. So we've seen this be a pretty boilerplate addition to the summary note of accounting policies. There had already been a requirement to disclose a note that you did allocate expenses, just saying that expenses are allocated based on functional or natural classification. Now, in addition to that, you're just adding how you do it, and that can be as simple as a sentence or two. So, for example, saying that you allocate salaries and fringe benefits based on real estimates of time and effort is one that we see often. Another, occupancy cost, depreciation, insurance by square footage estimates is appropriate. So it's enough just to disclose that and add a sentence or two about the methodologies by which you do allocate into that disclosure. The guidance does give some new clarification on exactly what you can allocate, which is new. I think that also got comparatively little attention when this was first introduced. And it introduces the concept of direct conduct and direct supervision. So direct conduct is easy enough. It's if you're directly performing a program activity or a mission-related activity, well, then a portion of your time can be allocated there. Same thing for fundraising, really. But likewise, the direct supervision standard is if you are directly supervising that activity, your time can also be allocated. So, I mean, the typical example is a CEO who spends their time overseeing a program. That time can be allocated to program services, also to fundraising. It doesn't need to be 100% admin. And that's been common practice for a lot of organizations, but not everybody does it that way. So it's something to think about that you do have the option. But the standard does speak to a few other examples of things that cannot be allocated. So they speak about human resources as an example that needs to be 100% administration. And when you think about HR and the direct conduct and direct supervision definitions that I just spoke about, that makes sense. HR is not involved in directly performing mission-related activities or fundraising, and they're not involved in the supervision of those for the most part. I mean, we see some small organizations where people have a lot of hats, and I think there's some judgment required there. But generally, HR is called out by the standards as 100% admin. And likewise, they speak about accounting. I guess accountants love to speak about ourselves. So I think accounting has always been kind of the typical example of what's fully administration. What about an accountant who prepares a report that's required by a government funder? Under the standards, again, it's not direct conduct of the program, nor is it direct supervision. So this clarifies that role is still 100% admin, and that is largely consistent with what we've seen in the past. The standards draw a distinction between that level of reporting and, for example, a program person preparing a research report as part of a grant deliverables. That's pretty clearly allocable to the program itself. So I also have some slides for your reference with a very, very brief functional expense example. And the next slide is going to be an example of the qualitative part of the disclosure as well. I think most people, again, from the 990 are familiar with this, but there's a lot out there since a lot of nonprofits have been doing this for a long time. And the number of natural categories that you include, I mean, this has seven or so line items: salaries, grants, travel, professional fees, occupancy, depreciation, and interest. I think that's appropriate. The 990 has 20-something lines, and we see functional expenses with that many and even more. So this can be based on your judgment about what is material to disclose and what makes sense for your organization to disclose, but there's really no set rules because it would be too cumbersome to really go through that for any organization. Everybody's going to be a little bit different here. But so judgment can really apply. And here, as I said, is an example of a footnote where if you see the first sentence here, first really two sentences here have been in most financial statements in some form. What's newer, the next two sentences, which speak about what expenses you're allocating and what method you're using to do that. All right, the next two changes, as I said, are pretty straightforward. So for investment fees, first, you previously had the option to report investment fees either net of the return or as a separate expense. Now you're required to report the fees net of the revenue itself, and that applies both to external expenses and direct internal expenses. External expenses is pretty straightforward. That's anything you're paying to outside fund managers or that's inherent to outsiders as part of your investments. Direct internal expenses is really for staff that's actually responsible for selecting and monitoring the investments, like a chief investment officer that gets net. So it's not applicable for most mid-sized, even large nonprofits. Work that you do, like accounting for investment transactions or coordinating with an investment committee, that doesn't apply. That's still admin. These are really for direct internal expenses, are really for anybody who's involved in the direct selection of investments. For universities or anybody with huge endowments is really where it's most applicable. The disclosure of the investment expenses is no longer required, but it's we are seeing some organizations choose to keep the disaggregation where you show the different components of return and net of the expenses. It's removed as a requirement, but I think organizations like it because you can also reconcile to 990 line items that way, but there's no kind of standard that continues to require you to disclose it as long as the expenses themselves are net of the revenue on the statement of activities. And finally, as I said, cash flows. I spoke briefly about this already. Nothing needs to change. Most organizations already use the indirect method of reporting, which is still okay. If you happen to use the direct method, which is shown on the top, you don't need to also show the reconciliation to the indirect. But honestly, that's not really a big deal or a time saver in my view. And the organizations usually that we see that use the direct method, there are some HUD requirements and other government standards that may require the direct method used, and I believe those standards even still keep the reconciliation to the indirect. So I haven't yet seen anybody change what they're doing in the statement of cash flows, and again, it's not really a major time saver. So I just think it bears mentioning because there's some confusion when the standard was originally introduced. All right, so I think, Mac, it could be time for poll question number 2, and we probably have time for a question or two if anything has come up before we switch gears and start speaking about conditional contributions. The second poll question, like the first, is going to be to gauge what everybody's comfort level is on the conditional contribution standards that are coming out.
Right, and I'll go ahead and launch that for you. We do have one question that we can go through too after we get the poll done.
Great.
Make sure we give everybody a chance to answer here. It looks like we were at about 70% are somewhat comfortable, 11% are very, and 20% are honestly saying they're not comfortable.
Okay, and that's pretty consistent with what we're seeing. I think some of the terminology in the conditional contribution gets to be a lot of it's just new, so it's something to think about. But as we'll see, a lot of where you end up in terms of revenue recognition should not have to change for most organizations. But it's the method by which you get there is a little bit convoluted and new, so it bears some attention. And Mac, was there a question as well?
There was. It's about statement of functional expenses and the allocation of time. Hope is asking, in smaller entities with limited infrastructure, is it wrong to allocate some portion of their time to programs if they do help out in that area?
That's not wrong as long as you can justify that you are involved in the direct conduct of the mission or the program. That's entirely appropriate. And as you said, in smaller organizations, everybody wears a lot of hats. So it's from an auditor's perspective, it's important to justify that, how you come up with that allocation. But it's extremely common, and any time that is spent actually carrying out mission activities can be allocated.
And there is one more if you want to throw in.
Sure.
You want to throw one more?
While it's fresh, because this is going to be a little bit of switching gears entirely, so I think it makes sense to cover it now.
So Matthew's asking the question of for net assets, will the 990 change to match, or will they keep the 3 lines?
Not yet is the answer. The 2018 form has still been there, and I believe the IRS has a lot of work to do, as you can imagine, with all the changes there. They're plenty backed up. I don't think changing the forms and instructions is a little bit more complicated for them than you might think. But I am still seeing organizations segregate out what was previously temporarily or permanently restricted. I don't believe that's required. I think that they released something that says you can keep your entire with donor restrictions number on one line item in the 990 if it looks better to just see it fully comparative to the financial statements, but it might be something that you disclose in Schedule O as kind of how you're doing it. But those forms have not changed yet. I'm sure they'll get around to it, but I don't know if that's in the immediate timetable for them. It's a good question. All right, so we're going to switch gears entirely, as I said, and move to a completely different standard, ASU 2018-08 for contributions. And I think to even start speaking about this, it's first important to get into something about why this was necessary in the first place. And that also requires me speaking about the new-ish revenue recognition standard. So revenue recognition is kind of a hot topic everywhere else in the accounting world. It applies to nonprofits as well. And I'll get into the revenue recognition changes briefly, but that's something that's also worthy of a full day CPE on its own. I'm not going to be able to do it complete justice. But the official title of that standard is revenue from contracts with customers. Under the definitions in those changes, a lot of nonprofit program service revenue would be included, for example. But contributions are entirely scoped out since donors are not customers. There's part of the standard speaks about what is the definition of a true customer to an organization. So far so good for nonprofits, since your revenue that's was thought of as an exchange transaction is included under it. Contributions clearly not. But FASB saw a problem with government grants. There's been some diversity in practice that's long-standing with the question of whether government grants are an exchange transaction or a contribution. One side of the argument says the government's not in the business of giving contributions, and they're the representatives of the direct public that the grants are meant to benefit. So therefore, that's an exchange transaction. That's, I think, what most organizations have done. But the other side of that, just to play devil's advocate, is that the government isn't really getting a direct benefit from the grant, so it's a contribution. And so the prior standards were not clear. There's been some diversity, as I said. I've always kind of personally been swayed more by the exchange transaction treatment, and I've just seen it more often. But I think there's some justification for either. The problem facing FASB is now, does a government grant really belong in a quote-unquote contract with a customer? So FASB came up with a standard as a patch, and the end result will be that most nonprofits will not change the timing of revenue recognition for government grants. But as I said, the mechanics by which that's done are kind of convoluted, and the way they did that is to really redefine government grants as conditional contributions. We'll see in a minute how that works. A second issue at the bottom of the slide is related to conditional contributions and how they had always been treated in the past. There had been some trouble determining what's a donor condition and what's a donor restriction. So do you recognize the revenue as unconditional and just keep it restricted, or do you not recognize it until a condition's met? So while FASB was changing the definitions for government grants, they also added some clarity on this for where conditions exist. So we have this chart that shows kind of the entire revenue recognition landscape. And I think this will be helpful, but the first decision in the tree when you get a resource is it a reciprocal or non-reciprocal? If it's reciprocal, you follow the revenue recognition standards. If it's not, you follow the contribution standards. And here's where I'm going to give my refresher and reminder on the revenue recognition. And again, there's full day seminars on this that I'd recommend if it's going to be a major impact for you. There's also a nonprofit specific guide that the ISCPA released. But the steps to recognize the revenue are laid out here. But the basics are that you allocate the price alongside the obligations that you need to perform for the customer. And then once the performance obligation is met, then you recognize revenue. Sounds easy enough, and it might not result in the change. I think a good example is a school. If somebody pays you tuition for a semester, and you recognize revenue throughout the course of the semester as you provide the services to the student. That's not a change from the current standards, but it is kind of formalizing the process by which you get there. The second half of the tree is for contributions, so non-reciprocal, non-exchange transactions. And this slide says proposed ASU, but this is now final. So the next step, the next question to ask is the contribution conditional or not? For a condition to be for a contribution to be conditional, you need to have two elements: a right of return or release. So that means the cash is at risk. If you have the cash in hand and you don't meet the conditions, you return it to the donor. And if you don't have the cash in hand yet, but it's been promised to you, the donor is released from the obligation to pay. So there's truly an element at risk if you don't do what you're supposed to do. The second element is that there must be a barrier to receiving the donation. And barrier is now a technical term, but I'll go over some of these and explain in detail. If it's unconditional, if it's conditional, you recognize the revenue once the barrier is met. And if it's unconditional, you recognize the revenue immediately, either as net assets with restrictions or without donor restrictions. All right, I know that's a lot to handle, but I'm going to go through this step by step and then have a couple of examples to get through and kind of show how the thought process works. So question number one is exchange versus non-exchange. The element of an exchange transaction is if direct commensurate value is provided to the resource provider. That means it's an exchange transaction. I said tuition for a school. That's a good example. A museum that sells a ticket is a good example. That's not new. It's a exchange transaction back to whoever's paying you. What's new here in the standard is that transactions that benefit the general public are specifically defined to be non-exchange transactions and should follow contribution guidance. That's what covers government grants. So the logic is the government is paying you, not getting a value directly back to them, but when the value is really intended for the general public, it is non-exchange. And you'll see when we get into the examples that you could come up with fact patterns where the government is specifically contracting you with something that's for a government agency. That's not really what we're speaking about. So this is not to say any transactions with the government are changing here, but the far majority of government grants really fall into that category, that they're for the benefit of the general public. Okay, so on that slide with the decision tree, for a condition to exist, you'll remember that it needed both a barrier and a right of return or right of release. So this is question 2, or decision 2, is it conditional or unconditional? So the right of return and release is pretty easy to understand, just that there's a risk to the recipient organization. Determining whether there's a barrier does require some more judgment. So there's a few examples that are called out by the standard. The first is inclusion of a specific and measurable performance-related metric. Usually that you provide services to X number of people, X number of hours, but there's a definition of something that you have to meet. Number 2 is the extent to which a stipulation from the donor limits what you can do with the funds, and any specific budget requirements or conditions that you have to meet in use might apply. And then third is the extent to which that stipulation is related to the purpose of the agreement. And I'm going to go over some examples of these that help explain this. It's important a goal may not be a barrier if it's not attached to the right of return or release. And we often see that with private foundations. So private foundation grant may give you some metrics to hit, but if you end up not meeting them, they're not going to take the money back. I think traditionally that it's assumed that might jeopardize future year grants, or at least deserve some explanation about why you haven't hit what you expected to. That's really a separate issue. The private foundations, they don't want to or generally want to keep their grants unconditional so they can take credit for the expense. So just because a goal is in an agreement doesn't automatically make it a barrier if it's not attached to that right of return or release of the assets. And unlike with prior standards, the likelihood of meeting the barrier is not considered. It used to be. I don't like reading this part of the standard because it's a double negative. But in the old atmosphere, if it was remote that you would not meet the condition, you could record the revenue immediately. That doesn't apply any longer. The condition has to be satisfied before the revenue is recorded. All right, so I promised examples. Example of a barrier. So nonprofit receives a $500,000 grant from a private foundation to provide after-school services. They're required to provide services to 10,000 kids with specific minimum targets that have to happen each quarter. there is a right of return of the transferred assets. So question number one, is it exchange or non-exchange? And sometimes when we do this in person, I ask for an answer, but I'm just going to give it to you. The correct answer is non-exchange because the grant does not benefit the resource provider. It's from a foundation that's not receiving a benefit. It is to benefit the general public. So you're on the contribution side of the decision tree. Second, is this conditional or unconditional? Because you both have the right of return or release, and B has some specific thresholds to hit, this would count as a barrier, and that's a conditional contribution. So let's say you're an organization that serves 100,000 kids a year. Someone gives you something conditioned on 10,000 at the beginning of the year. It is clear that you'll do that. But as I said, likelihood is not really considered anymore. You cannot record that revenue until you meet the full 10,000 threshold. And also, this example has quarterly minimums, so you technically have to recognize the revenue quarterly over the period, depending on how the right of return and release is spaced out. Okay. Example number two: a university gets a research grant from the government. They have to follow uniform guidance rules and comply with O&B rules and regulations. That means they need an annual audit, some program reports. The grant comes with a budget of expenses that needs to be used in accordance with O&B rules and rules from the awarding agency. Anything that is not spent is forfeited back to the government. Any unallowed costs or disallowed costs need to be refunded. University retains rights to the research, and the summary of the research findings is made public. So question number one, is this exchange or non-exchange? So who does this benefit? The findings are made public, and the university keeps the right to the research. So FASB would say there's not a direct and commensurate benefit to the government agency, and this is non-exchange. Use contribution accounting. You could conceivably, it kind of alluded to this before, but come up with a fact pattern. Let's say the government was truly paying for research that is not public and owned by the government agency. I think there you might get to a place where you could use exchange transaction basis, but not in this circumstance because this is really intended to benefit the general public. You're talking about a non-exchange transaction. Question number two, is it conditional or unconditional? There's definitely a right of return or release in there. Because there's a grant budget that's set by the agency, the university has limited discretion, I'd say, on the use of the assets, and also because they have to meet agency rules, O&B rules, that also limits what they can actually do with the money. So I think that meets the definition number two of a barrier of limited discretion on how you use the assets. So not on this slide, but the audit requirement that's in there, you're required to obtain an annual audit, any program reports. Since that's not related to the purpose of the agreement or the real right of return or release of the assets, that doesn't constitute a barrier under the standards. It's a compliance requirement of the agreement, something you have to do, but it's not really the main purpose of it. So you would never really find yourself in a position where you've done what you're supposed to do under the government grant. You just haven't had the annual audit until the next year. You can still recognize that revenue once you've met the barrier that's really substantially attached to the grant. Okay, so we're almost there. FASB has almost solved the problem, but there's one additional quirk of this, is that if a government's giving you contributions, well, then that's most likely going to fall into net assets with donor restrictions. There's going to be some inherent use that you need to use the money for generally. And a lot of people didn't love that because it's calling the government a donor on the financial statements. And it's a big change for a lot of organizations since they've always put that revenue in the old unrestricted column, now without donor restricted column. So FASB found a fix for this as well. Under previous GAAP, the rules have always been that you have the option to simultaneously release restrictions. So if you meet the restriction in the same period that you get the gift, you can just choose to report it as, you could have just chosen to report it as unrestricted revenue, now revenue and net assets without donor restrictions. The only catch is you have to follow that policy consistently. You can't cherry pick individual contributions to use that for. So the same rules apply, except that FASB also allows you to create two buckets and treat them differently, which is new. So you can have simultaneous release for conditional contributions and read into that government grants, and non-simultaneous release for other contributions. And again, that's a workaround to kind of get to the same place where you always were, where that in the past was that a government grant. Once you spent the expenses for that, you'd recognize the revenue, and that would all show up in the old unrestricted column. Now you can kind of get to the same place, that you are meeting conditions by expending expenses against the budget. That lets you recognize the revenue, and if you choose, you can keep that both that revenue and expense at the same time in the net assets without donor restrictions column. So I know that's again, with a relatively short period of time, it's a lot to get through, but and we're seeing that for most organizations are kind of the financial statements are going to look the same, but these steps in this process has to be thought through for each of the different funding sources and revenue streams that you have. So one last piece of information on this: the effective date is periods beginning after December 15th, 2018. So that means it's starting with calendar year 2019 year ends, which is effective now. If you're a quote-unquote public nonprofit, if you issue public debt or a conduit bond obliger, that effective date moves up to June 15th, 2018, so it could conceivably impact your June 30th, 2019 financial statements. And the reason they did that is to kind of match the revenue recognition standards where public nonprofits, quote-unquote, are implementing now, and non-public have the opportunity to do it later. All right, I'm going to do a little bit of a lightning round through these last few, and then we're getting close, but leave a little bit of time for questions. Leases is another standard, as I said. It deserves an all-day type of session, but the headline news here is that your future lease commitments are getting discounted to present value and placed on the balance sheet as an asset and a liability. That concept has been around for a while versus a proposed ASU that was floating around, and then the standard it was released in 2016. But given that this affects everyone, not just nonprofits, you can imagine retail organizations with a ton of stores. The actual implementation of this can get pretty hairy. So it's been delayed a few times, and for nonprofits and again, the quote-unquote non-public nonprofits, if you don't have public debt, FASB just voted to delay that implementation for another year. So you're looking at periods beginning after December 2020, which means calendar year 2021 financial statements and later. But if you do happen to issue public debt, this applies starting in calendar year 2019. So it's coming up. What's important to do now is to examine your leases, make sure you have a handle on all your lease terms. If you have any debt covenants with balance sheet ratios, speak to your banks about this. We've been saying that since 2016, but at first it seemed that bankers didn't really have a total handle on this. Now, because it's affecting everybody, I think it's much more commonly understood, and it wouldn't affect something like a debt service coverage ratio or something based on your annual revenue, but there are some agreements out there that have some balance sheet covenants that are important to kind of get through. And this slide shows the distinction between operating leases and what used to be called capital and is now finance leases. Capital leases, the presentation is really not changing much. It's already on your balance sheet and will continue to remain there. But operating leases have not. That'll be entirely new. So particularly for if you have a long-term lease, there's going to be a pretty big number that's going on your balance sheet as both an asset and a liability. And you're measuring it again at the present value of the remaining payments as of the balance sheet date. The changes as into the statement of activities or statement of functional expenses, wherever you're showing the associated expense for these leases, operating leases will be a single lease expense line item that's done on a straight line basis over the life of the lease. And for capital and finance leases, there'll be two line items, one for amortization expense of the asset and one for interest expense on the liability. So again, that's not that is kind of the really short answer to not do this justice. And since we're almost at the end of our time, I want to do the final poll question of the day. Maybe some market research for us, but to see who on the meeting expects the revenue recognition standards to impact your organization's timing of revenue recognition.
Nothing wrong with market research. We're looking at
I said that I wouldn't expect many changes for what most were seeing. So I don't know if that's going to color it too much, but I'm curious to what people are seeing out there in their own business.
So yes, we have about 50%, 56% no, 26% yes, and 18% not sure.
Great. So that's again kind of as expected, but I know it's kind of a convoluted process to get there. So it deserves some thought now before you really have to start implementing and putting together financial statements based on these. So I have one final slide on other recent standards that I think are not really that are coming up for 2020 and later. So it's not immediate, but everybody should be aware that there was a standard released at the end of last year on cloud computing that aligns kind of the way that there was already guidance on internally developed software and what you can capitalize. This is basically applying that guidance to cloud computing and hosting arrangements so that you don't have to expense it all. You can capitalize that. Any new ERP implementations, there's a ton of this that's now in the cloud. So it kind of makes sense to align with how people are actually buying software licenses. And what was just released, 2019-03, is for collections, which really is for museums, and it aligns the FASB definition of collections with the definition used by the American Alliance of Museums. It removes some diversity in practice, but it is also not, I think, a major change for some organizations. There's going to be some associated disclosure requirements if you're a museum and have some collections. So I think we have a few minutes if there's any questions, Mac, but
yeah, we'll go through one or two.
Great.
Just a couple. Let's see. Kimberly wants to know, if you have state grants and federal grants, can you treat one as restricted and the other as unrestricted? Or with the new rule, should it be consistent?
So I think in that case, it's going to have to be consistent. The two buckets that you're allowed to use are anything that was initially conditional and all other. So if you're under the logic, I'm assuming that both of those federal and state grants will have some sort of conditional contribution element to it, that they'll have the barrier and all of that. They should be treated consistently for GAAP purposes.
Okay, great. And then one final question. Does the recognition change apply to expense side for grants? Meaning you cannot book a grant as a program expense until certain deliverables are met?
It does not. I'm trying to think through all rapid fire all the different examples of government grants I've seen. For the most part, it doesn't. You expense, you have the expense when it's incurred. And for many government grants where you are depending on, the old method was you recognize the revenue to match the expense you're spending, because that will that's really how you see yourself as meeting the exchange transaction criteria. It's going to be the same thing. The incurring the expense is going to meet the condition of a barrier that fulfills the condition of the grant, and you get to recognize the revenue. So I'm gonna have to think some more about that, but I think in most cases it will not affect the timing of expense reporting.
Okay, great. Well, that's all the time we have. There were some more questions submitted. I'll make sure Matt gets those and the team gets those, so perhaps he can follow up. But other than that, here's his information. Please feel free to bother him often. And thank you for your time today, Matt.
Thank you, Mac. Thanks to everybody for your time, and to 501c Services for hosting us again.
Thank you, guys. Everybody have a great week. Bye.
Bye.